Okay, thanks. For this week, we will be sharing on our update on the Singapore REITs, company updates on First REIT and Keppel DC REIT, and weekly updates on China and our musings for the week. So the S-REIT index has declined 5.8% year to date, and the current yield spread is at 5.5%, which gives us a yield spread of 300 basis points. For the first time this year to date, it has ticked up above the -1 SD range, but it still remains very close to the -1 SD range and is still far away from the post-GFC historical average of 358 basis points. As we have mentioned in the past few reports as well, rising interest rates will be a headwind for S-REITs from a yield and interest expense perspective, but rental growth can be a mitigating tailwind. On the short end of things, the 3-month SOR is currently at 1.63%. However, near-term financing costs are largely mitigated, as upon our assessment, most of the REITs have at least 70% of their debt hedged on fixed interest rates. And to give a quick overview of the subsectors, for retail, Jewel and Funan, these are the two bigger supply additions to the retail market next year, 2019. So both of them reported the take-up rates, 90% for Jewel and 70% for Funan's retail component. However, for Funan, subsequent to them reporting this take-up rate, news of one of their anchor tenants, New State Technologies, being in liquidation surfaced. And on the macro front, retail sales ticked up marginally by 2.4% year-on-year in August, with fashion and watches and jewelry being some of the top contributors. For commercial, we are seeing co-working operators expanding. So there's this new thing called the Core Flex model, where SMEs in co-working spaces can choose to lease workspaces, and conventional tenants can have the option of flexible space as and when they need it. So big players such as CapitaLand are investing in large amounts in this. So for CapitaLand, they invested in the co-working operator, the Work Project Kingdom, where they will lease space at Capital Tower and Asia Square Tower 2 from CCT. On the industrial front, the scheme of arrangement for the merger between ESR REIT and Viva Industrial Trust has concluded, and Viva Industrial Trust stapled securities are expected to be delisted today. Hospitality RevPAR is currently at 5-year high. It has inched up both on higher occupancy and average room rate. Historically, the months of July and August had clocked the highest monthly occupancy rates for the past 3 years. So overall, commercial and hospitality seems to be doing the best. Hospitality is actually the best performer both on a 1-month basis and year to date. Overall, we remain neutral on S-REIT sector. However, we do like the office and hospitality subsectors due to tapering supply, especially after the surge in supply in the prior 2 to 3 years. And for office, as we have seen in the past quarter, cap rates have also been tightening, and hospitality RevPAR has been inching upwards. On the right, we have a overview of the calls of the S-REITs under our coverage. And our technical bottom-up view is that in a rising interest rates environment, we do like REITs with low gearing, high interest coverage, long weighted average debt to maturity, and a higher proportion of debt on fixed interest rates. Some of these REITs are CRCT and Keppel DC REIT, both of which we have accumulated calls on. So this is just an overview of the S-REITs universe that we have at the back of our report. As mentioned earlier, hospitality is the best performer on a 1-month basis and year to date. So moving on to First REIT. First REIT released their 3Q FY18 results last week. Gross revenue and NPI were both up in excess of 5%. This was due to contribution from their 2 properties acquired last year. NPI margins were up slightly because even though their rentals are triple netted, the lower property operating expenses did contribute to a higher NPI margin. And also, if you have seen our latest report, there was a proposed transaction of First REIT's sponsor, Lippo Karawaci, potentially divesting their stake in First REIT as well as First REIT's manager. So this to OUE Lippo Limited and OUE Lippo Healthcare. So pending the respective approvals and provided this goes through successfully, First REIT would have the right of first refusal ROFR pipeline to OUE Lippo Healthcare's assets. And this will be in addition to their current ROFR pipeline to Lippo Karawaci. So the positives would be the potential expanded ROFR pipeline and improvement in tenant concentration, given that Lippo Karawaci is currently their current single biggest lessee. However, for the negatives, as we have pointed out in the past few quarters, receivables collection remains slow, despite 17.5 million of rental payments being received after the quarter on October 15 as disclosed by First REIT. So even excluding this, receivables would increase about close to 10% quarter on quarter, and this translates to about 4.4 months receivables days. Outlook-wise, this has improved from a potential positive spillover effect from the potential cash infusion from the Lippo Karawaci's divestment of stake. However, it remains to be seen if there could be any real marked improvement in the near term, given that the transaction is still pending the respective approvals. Overall, we remain neutral with a slightly lower target price of $1.30, as we had previously factored in an acquisition that would materialize in the third quarter. So moving on to Richard to talk about Keppel DC.
Thank you, Tara. This is Richard speaking. So we published our Keppel DC REIT report last week following their 3Q results. We're maintaining accumulate for Keppel DC REIT. Target price also unchanged at 145. We are forecasting a DPU of 7.04 cents for FY18. That will give you a 5.2% yield based on last close price on Friday of 135. In the table, you can see that gross revenue has significantly increased by 34% year on year for this quarter. This is due to inorganic growth. They have this is from contributions from 3 properties that were acquired over the period. And then net property income also is correspondingly higher at 33% year on year. And distributable income is 29% higher year on year at 26 million. However, DPU growth is smaller at 6.3%. So for third quarter, there's a 1.85 cent DPU compared to 1.74 in the same quarter last year. This is because of the enlarged unit base from the private placement that was held in May this year. The number of units has increased by 20% year on year. From the results, there are some positives. The REIT remains operationally stable. Portfolio occupancy is still high at about 93%. And the portfolio WALE of 8.5 years is one of the longest among the industrial REITs. Long WALE is positive for visibility on their cash flow as well as long-term tenant retention. For cash flow wise, it's stable and predictable due to limited renewal risk as well until 2020, and foreign source distributions have also been hedged. So for the remainder of 2018, only 0.1% of leased area is up for renewal. And then for 2019 and 2020, each of these years has less than 5% of space at risk. For foreign source distributions, they've been hedged until the first half of 2020. The REIT also has a low aggregate leverage of 32% and does not have any refinancing needs for the remainder of 2018. So the next debt maturity is in 2019. With this low gearing of 32%, we estimate that there's a debt headroom of about 270 million, assuming 40% target gearing, which can be used to grow the existing AUM by about 13.5%. For negatives, some cash has been retained for capex reserves. Year to date, the REIT has retained about 2 million of cash for these capex reserves. Outlook for Keppel DC REIT is positive. Demand for data center remains robust, and there's healthy occupancy at larger operators such as Keppel DC REIT. Only the smaller boutique operators are having oversupply at the moment because of their track record, and so reluctance for tenants to sign up with these smaller boutique operators. Downside risk for Keppel DC REIT is the valuation. So valuation is rich. Our target price is an implied 1.36 times of price to book multiple. Now we'll move on to Mike, who will talk about China.
Hello. For China last week, for the fiscal policy side, on October 16th, the China's approved the establishment of the Hainan Free Trade Zones. Hainan Free Trade Zone is the 12th free trade zones of the China's, and we already see a policy performance in crossing over industries like traveling, investings and worldwide shoppings, especially for the traveling. The policies allow the people, the cruise travelers to enter into the China without applying for visas, and you can stay for 15 days. On October 20th, China released the details to draft plan for the personal income test cards. And they added the six categories of the tax expenditures, including the educations, the medical expenditures, and housing mortgage. For the monetary policies, last week the central bank returned a net about 600 billion RMBs, but 415 billion of them is financing by the cut down of the RRR ratios. So we can see actually last week's interest rate is down last week. From the fiscal policies and the monetary policies, we can see the China government is still focused on the cost reductions and to boost the consumptions. For the economic indicators, the last week, both the CPI and the PPI is meet the expectations, but we are worried about the Americans will impose sanctions on November. So we're ready if the oil price increasing unexpectedly. There will be a worry on increasing CPI and the PPI. For the GDPs, is 6.5 on the third quarter, below the expectations. So we can see on October 20th, the China's released a draft to plan to release the personal income tax cuts. This move is supposed to do to boost the consumptions. For the stock recommendations, the Hong Kong research teams recommend the Wang channels of the internationals, and the Huayu Autos. This three stock recommendation is based on the positive industrial outlook, and there is a good financial situation for now. And we'll move to Paul for the weekly amusing.
Okay, thanks, Mike. Paul here, just to give a weekly roundup. Sorry. Okay, for week 43, this is just our usual short-term views. In terms of the key highlights for macro last week, as we all saw, there was the FOMC minutes that was released. I think we all know that this is it's although they say minutes, but in actual fact, it's more like a public statement, since everyone knows that these minutes are actually published for everyone to see. But anyway, I'll move on. Anyway, from the minutes, most officials are looking for 3 more rate hikes in 2019. The key was also the so-called neutral rate. It seems to be between 2.75 to 3%. But what kind of spooked the market a little bit was that it was mentioned that they need to raise interest rates to a more restrictive mode to be above this so-called neutral rate. So we can expect rates to eventually move even above this 3%. Anyway, the key message here is that based on current scenario, expect directionally very strong interest rates coming up from the US. The other key macro was, of course, news of a downgrade by Moody's. I guess on the flip side, they didn't downgrade Italy to junk. This is important. The rating now is just the lowest rate, the lowest lowest investment grade. But the problem is that if it goes into junk status, then you have the problem because ECB cannot come in to buy non-investment grade sovereign bonds. I'm not sure what happens is actually if they actually hold it and it gets downgraded, whether they technically have to sell it or not. But anyway, the Italian noise is just something to monitor. In terms of Singapore macro, of course, like mentioned by Tara, there was retail sales, but I think retail sales in Singapore is still pretty lifeless. I think you're looking at about 1 to 2% kind of growth for the year. The other news that came out was Singapore exports, which I think rose 8%, but I think that actually was better than they're actually pretty healthy in view of the current environment. But most of the growth came from a spike in chemicals. Chemical exports rose 23%, and chemicals is actually even larger than electronics, which electronic exports continue to trend down. In terms of corporate sector news, I think we also saw the Singapore property measures that was announced. They've actually raised the minimum average size. So basically, any development now, you have to sell larger units, and it actually on paper would mean that to keep it affordable, the price per square foot actually have to come down. I guess the positive spin to that, to this, of course, is negative news, but if there's any positive to it, is that the government URA didn't impose a minimum per unit size. That would have been more disruptive. And the other positive, I guess, is that it's only if the developers submit the applications before 17th of January, they can still revert to the old minimum average size. So I guess on a relative sense, that will be the two positives. The other part was also the bonus area was cut to 7%. In terms of corporate news, there was a SPH news. We don't cover SPH, but just I attended the results briefing, so I'll just brief everyone. Anyway, they cut the dividends from 15 to 13. And do note that just a few years ago, the dividends was as high as 21 cents. And if you just look at the ordinary dividends, because SPH always pays a special dividend at the end. So if you just look purely at ordinary dividends has been down more than 40% since 2012. So in terms of the outlook, the problem for SPH now is still, they still have, as you know, they still have this classified and recruitment revenue. And you're looking at 100 million of classified and recruitment revenue, which is under threat. And this revenue is virtually a pure profit for them because it's just ad revenue. So they still have a big exposure to this segment of the business. And at 100 million, this is quite a big chunk of their operating earnings, which is about 200. So even if you assume half of this goes, it's still a big hit to their operating earnings, which is something that they will still have to grapple with the next 1-2 years. In terms of tactical, again, still a very cautious backdrop. I think maybe the bank earnings when it comes up will give us some direction in the near term. Like mentioned before, you still got the midterm elections, global growth soaring, and rising interest rates. In terms of the stocks we like, we did issue a note on SGX. I think even though, as we all know, securities volume is down, but I think derivatives actually picked up much stronger than expected. It's up 20-odd%. And also and overall for the market in the more intermediate term, the STI valuations actually, like we mentioned last week, actually turned more attractive. You're hitting at the below 1 standard deviation valuation, something that you don't usually see. And also in terms of weeks ahead, we have the US GDP coming up and also Singapore IPI numbers. Okay, I think that's it for us. If you have any questions, yeah, please post them. Thank you. Yeah, okay, thanks for the questions. Oh, sorry, yeah, it's really ended, sorry. Yeah, anyway, how are you tracking the recession indicators? Yeah, we will be updating, as you know, the previous analyst that was updating these recession indicators, he has left. But so far, when we last checked it, there have been no red flags, but we will give you an update next week. Thanks for the question. Any reason for SPH cut? Okay, SPH, the reason SPH gave a very convoluted answer for why they cut. But anyway, this from them, not from me. They say that if they give a higher dividend, also market may not appreciate it because even by cutting dividend, the yield now is already 5%. This is their rationale, not my rationale. Okay, but anyway, their rationale for the low dividend is just that at the current dividend per share now, you're already enjoying a 5% yield. But of course, it's counterintuitive because if you didn't cut, maybe the share price would have gone up. And you wouldn't get such a high yield. You still can get the same yield. But anyway, that's from them. Hold on, we got another question. Okay, we got another question here. Where is the best market to invest for mid to long term, Asia or America? Again, we don't have any data to support this, but I guess for us would be Asia would still be the better market considering how far the US equity markets and also the currencies have run. I mean, just a general answer. Yeah, thanks. Hold on, there's one more logistics REIT question. Okay, we got a question on the tariffs being played out in a very long manner. What would be the significant impact on logistic REITs, especially those who are already well diversified by clients? Just a very general answer. Most of the logistics tend to be those that are listed here tend to invest in Asian assets. So unless those who have warehouses that are based in China, that's located within their free trade zone for re-export, maybe those will be affected. But those in this very general answer, but those warehouses that are just mainly for domestic market won't be that significantly affected. Yeah, so that would just a general answer for that. Yeah, thanks. Yeah, okay. There's one question. Do you have any impending signs of a US major downturn before the forthcoming? I think any downturn, like we mentioned before, is probably after the election. Again, the rationale why we say that is that there are two scenarios. If, like we mentioned before, if they lose the lower house, then there could be two repercussions. Firstly, as we mentioned, there was going to be an infrastructure bill. Of course, some say that the Democrats actually support the infrastructure bill, but I mean, to support infrastructure bill, you're ultimately going to help Trump in his popularity. So we don't think that's going to happen. So the market will be disappointed that there will be no infrastructure stimulus if the Republicans lose the lower house. The second impact will be if they lose the lower house, you're going to get a lot of noise on it won't be impeachment noise, but there'll be a lot of noise on investigations on Trump and subpoenas and so forth. So from that angle, that won't be positive for the US market. As you know, any impeachment, you need to control the Senate, which probably the Democrats won't be able to do it. But there'll be a lot of political noise on taking actions on Trump and so forth. So that won't be positive if they lose the lower house. Okay. Yeah, there's one more on KDC.
Hi, there's a question on whether REITs are still attractive with the rate hike increasing. So there are two fronts where the rising interest rates would affect REITs, on the yield front and the interest rate front. So as we had mentioned, on the yield front, it is still at -1 SD post GFC, which i.e. Not attractive from a yield perspective right now. On the rising on the financing cost front, most of the REITs have their debt about 70% hedged. So there's not too much of a concern on the finance cost side. So it's only on the yield front where we would have to look out for rental growth as a mitigating tailwind. So on that front, we are more positive on the commercial and hospitality subsectors. That being said, we also have to look into each individual REIT for the idiosyncratic factors that would see whether or not they would be attractive on the yield front as opposed to the S-REIT subsector as a whole.
Yeah, there's a question for Keppel DC REIT about the fourth quarter DPU implied is 1.57 cents, seems a bit low. Yeah, that's the reason for that is that's the baseline. First of all, if you have to expect it to be lower year on year because of you have to expect some weakness in it year on year because of the dilution from the private placement. Also, there's this rental top up, which is recognized periodically. So that's the part where I say is baseline is that we do not assume any rental top up yet. So 1.57 will be the kind of like the estimated minimum subject to this rental top up, which is recognized periodically.
For Hong Kong's and the China markets, the rising on Fridays and today's, I think is mainly because of the government. There is a strong policies on both income tax cut on the income tax reduce, and the central banks says it will encourage the commercial bank to financing the private companies. But we think there is the problems of the China companies like the high debt and is still remaining, and the China RMB is still weakening. So we can I think it's a short-term effect on the stock market.
Okay, since we have no other questions, we will end the webinar for today. Thanks and see you next week.